401k retirement plans. A 401k retirement plan works a lot like a traditional IRA. Participants' contributions don't count as taxable income in the year received. Both the investment and the investment earnings get taxed at withdrawal, but from the time of investment until withdrawal, nothing is taxed. Just like in an IRA, you build a much bigger nest egg than you would in a fully taxable account in almost all cases. 401k plans have been gradually replacing pensions as the primary source of retirement income in the United States for several years. 401k plans were authorized by Congress in 1991. Want to guess why we call these plans 401ks? Yes, Section 401k of the IRS Code contains the language that describes it. Collectively, 401k accounts are huge. According to the Investment Company Institute, 401k assets were $1.6 trillion in 2002. That was about 15% of the U.S. retirement market in 2002. By September 30th, 2012, 401k assets had climbed to about $3.5 trillion, or about 18% of the U.S. retirement market. But these are not all huge accounts. The average account balance was $58,991 by the end of 2011. Given that IRAs and 401ks are pretty similar, you might expect that the investment allocations for the two are also pretty similar. You'd be right. Stock mutual funds are the most popular choice, with about 40% of 401k investments in that category. By the time you add stock mutual funds, the equity portion of balanced funds, and the employer and company stock, you'll find that 401k owners had just over 60% of their funds invested in stocks at the end of 2011. It makes more sense to put an investment that gets taxed heavily in your tax shelters. If you decide that stocks are your choice, then it makes sense to put high dividend stocks in your IRA or 401k and keep low dividend stocks outside. There's some evidence that high dividend stocks offer higher expected returns before taxes than low dividend stocks. The reason is that dividends get taxed more heavily than capital gains, so high dividend stocks have to pay more before taxes to make them fair deals after taxes. If you decide to put stocks in your tax shelters, then fill your IRA or 401k with your high dividend stocks and keep your low dividend stocks in a regular account. This runs counter to the advice you'll get from some other sources. Some people think that because your IRA or 401k investments are long-term, you can afford to put risky stocks, which tend to be low dividend stocks, in them, because the variation of your return evens out over time. But we learned in Lecture 4 that this argument is simply wrong. The longer you stay in the market, the more risk you bear, not less. Remember, the range of potential rates of return narrows over time, yes, but the range of potential payoffs in dollars doesn't. The longer you're in the market, the bigger the potential gains and losses in dollar terms. And you didn't need Lecture 4 to know that you buy things with dollars, not rates of return. The best thing about 401ks, or at least some 401k plans, is the employer match. An employer match is just what you think it is. Your employer matches your contributions. Not every plan offers an employer match, but it's great for employees of plans that do. Usually, the company only matches a relatively small amount, maybe 2 or 3% of your salary. But if you make $100,000 a year and your company matches 401k contributions at 2%, then if you deposit, say, $2,000, the company will kick in another $2,000. Where else are you going to get an immediate 100% return on your investments? The IRS limits employer matching contributions, usually to around 6% of an employee's salary annually. You'll also face an annual contribution limit, just like with an IRA. The employer's contribution doesn't count toward that annual limit. For example, you can make the maximum 401k contribution of $17,500 in 2013, and if your employer matched the first 4%, then that match would be deposited in your 401k account in addition to your contributions. Not all 401k matches are dollar for dollar. Lots of matching plans match 50 cents per dollar. That's still worth grabbing. Where else will you get an annual return of 50% on your investments with almost no risk? Most 401k plans don't vest all contributions immediately. That means that some employers don't allow workers to keep any of the 401k matching funds until they've been with the company for a set number of years. For example, about 1 in 10 employers fully vests participants in the plan after 3 years of service. If workers leave before that, then they don't get to keep any of the match. You're going to face the same sort of early withdrawal penalties on your 401k as you will on your IRA. We won't get into that because they're much the same as for your IRA. Consult a tax expert if you need the details. Many companies allow employees to buy company stock for their 401k plans at a discount. That sounds deliciously tempting, doesn't it? Who wouldn't want to buy, say, $1,000 worth of stock for $800? I certainly would, subject to an important caveat. I don't want to hold too much of any one stock, especially my employer's stock. I want to stay diversified. That counts double for the stock of the company that pays me, because I don't want my job and my investments to collapse at the same time. The best strategy is probably to buy as much of the discounted stock as you can, but sell most of it as soon as you can. Reinvest the proceeds in some other asset so that you don't have all of your eggs in one basket. All investment vehicles are subject to the rules laid down by the government and agencies like the Iras. Unfortunately, the government can change these rules whenever it wants. That means that if you like the sound of these investment vehicles, then you're not quite home free. You'll need to check to make sure that the rules in force at that time still work to your advantage. Of course, that's true for any investment. We can't avoid this risk. It's just the way life and the government work. In our next lecture, we'll be studying initial public offerings of stock, or IPOs for short. If you want the executive summary, it's simply this: all bets are off